All right, so Seth just went through top 10 markets for each of the property sectors based on the risk-adjusted IRR. And as he mentioned earlier, the market grade, which represents long-term rent growth potential, is a key component of that buildup. So I'm going to be focusing on changes of grades for a market, which market moved up within each of the core property sectors and which market moved down in our most recent published last month versus what we published earlier this year. So starting on the top left with apartments, looking at Baltimore, we moved up the human capital score. Baltimore is home to University of Maryland, Johns Hopkins, and several other local universities. There's also below average intermediate term supply growth, which is supporting landlord pricing power. So Baltimore moved from a B to a B plus from a market grade. Seattle moved down. As we dug deeper into the market, we made actually a negative analyst adjustment because of the recent supply growth. So when we looked at our supply barrier score, we didn't think that it fully captured what's structurally happening in that market. Moving to the right for industrial, for Cincinnati, Cincinnati moved from a C plus to a B, and that's based on the transit connectivity component. We increased that weighting across the board. The Cincinnati Northern Kentucky International Airport, or CBG, if you know that one, is one of the top 10 largest cargo airports in the US, and it really helps drive that market's strong transportation and logistics component. On the other hand, Oakland, we moved down from an A to an A minus, and that's mainly based on desirability in the marketplace. Moving over to office, focusing on Richmond, we actually had several improvements in various components. We increased desirability and fiscal health, and then also rental regulation and supply barriers went up slightly. On the other side, for San Francisco, obviously, you've seen in headlines a lot about crime, homelessness, and affordability. We think that is going to impact the city over longer than the next 5 years because we don't think that there's going to be material changes unless there are policy changes in the near term. I'm highlighting it for office, but we actually reduced grades for San Francisco across the core property sectors. And then moving on to strips, as Seth mentioned, strips is much more of a localized business. It really depends on the individual property as opposed to more of a market focus. But from a grading perspective, Dallas moved up from a B plus to an A minus. We're continuing to see strong fundamentals here. Dallas also has the highest ranked submarket in the entire coverage universe. So that's Park Cities and University Park. On the other side, Portland moved down from a B plus to a B, and we saw a decrease in the human capital and desirability score, which is based on persistent and elevated crime.